Okay, well, good morning, everybody, and welcome to our discussion regarding future real estate investment in opportunity zones and key changes to your tax plans. My name is Lee Small, and for those of you who do not know me, I am the Vice President of National Business Development for MBL Title. Some of our other key members joining us from our team include Founder and Chief Growth Officer Matthew Lopez and Founder and CEO John Myers. President Michael Hoffman is also on, and we also have another business development officer who runs national stuff with me, Isaac Tawaefa. So thanks, Isaac, as well. And I would be remiss if I didn't give a huge shout out to Anita Williams from our team for putting everything together, tirelessly working behind the scenes to make sure everything looks great and goes off smoothly. So thank you again for all your help, Anita. One quick note. Really important for those wishing to ask a question, we're going to be taking all the questions using the Q&A chat at the bottom of the screen. That way we don't have any audio feedback issues. So if you do have a question throughout our conversation, please feel free to drop it in there. We'll also have some time at the end to focus on questions. We probably can open up the mics then. I'll be following along with the questions. I'll be able to throw them into Gerry as he goes along in his presentation. So we really want this to be a full conversation. Please throw them in as it's warranted, and we'll discuss them. We are very excited to have the next hour to discuss opportunity zones with one of the foremost experts in the space. Gerry Reihsen is the founder and CEO of Coasis Coalition Companies. Coasis is a public benefit company that provides support, services, and products to the opportunity zone ecosystem, including its investors, agencies, organizations, and state and local economic development agencies. He's also spent time as the co-founder, executive vice president for corporate development, and chief legal officer at Barringer Harvard from late 2001 to January 2014. Since that time, he has founded or been on the board for 8 companies, graduated from Ole Miss, so we can talk SEC football if we want, also received his JD from the University of Wisconsin-Madison. Gerry, it is great to have you. Thanks so much for taking some time today to speak to us.
Thank you, Lee. I actually prefer to talk Big Ten sports because frankly they're doing better than the SEC right now.
we could do that. There's probably a decent blend of both on the call. So appreciate your time again today. I know this is an area, and we talked about this yesterday on our pre-call, that I think a lot of people have heard the buzzword, have heard little bits and pieces of it, but are excited to get more full detail and information on it. So I'll turn it over to you to get going and introduction, and I'll follow along with the chat. And if there's questions or questions that I have as well, I think people might be interested in, I'll just lob them in there for you. So rock and roll.
That sounds great. Yeah. So feel free to type in. I guess Lee has muted everybody, so feel free to type in the chat box or whatever. And if there's something relevant along the way, I welcome Lee to bring them up. Otherwise, we'll address most of the questions after the presentation. I think Lee went over my background, and feel free to touch base if you have any questions after this. Look, there's been a lot of kind of misinformation, although frankly, no information and no understanding is more dominant in the opportunity zone space. This is not a tax loophole. This is an intentional program. And the big point is, first time ever that I've ever heard of, you can invest in tangible assets. That includes real estate, but is not exclusive to real estate, and in businesses with tax-free upside after a 10-year hold. Frankly, that is the only thing that most people need to know. There are some other benefits. People get themselves wrapped around the axle on those, but they're irrelevant compared to this benefit. So any business person, any investor, any real estate developer, any fund manager, every single person who has anything to do with generating capital other than or wealth other than as an employee should be thinking about this. Now, that doesn't mean you should go it on your own. You should definitely get someone to handle the compliance. My general comment to anyone who's questioning whether they can set up their business or do their real estate deal as an opportunity zone deal, my general answer is yes. There's always a way to figure it out. And what we do is, that may be a little bit of overstatement, but what we do is we absorb what our clients, both on our legal side and our capital raising side and our consulting side, want to do, and we adapt the opportunity zone model to them, not vice versa, what they want to do. So forget all of the political posturing about it. It was actually an Obama era concept. It was introduced a few times during the Obama administration. It happened to get stuck into the Senate version of Trump's tax reform bill, i.e. it wasn't negotiated at the House as the rest of it was. So it was kind of stuck in there, but it was stuck in there in a bipartisan way. Cory Booker and Tim Scott, senators from the opposite ends of the spectrum, were the sponsors of it. It remains a very bipartisan initiative. It was actually something which was, if you understand where it came from, you can understand some of the what appears to be illogical nuances of it. And that is that a Silicon Valley guy, Sean Parker, the famous Facebook investor, wanted to do something about wealth aggregating in pockets around the United States, and wanted to see if there's a way to encourage that wealth to be invested in underinvested communities. He came up with this idea is that if wealth creators would put their reinvestment of their wealth in underinvested communities, they would get some tax benefits. That's why you have this kind of illogical concept that you only can put capital gains into an opportunity zone investment to achieve the tax benefits that the opportunity zone statute provides. Logically, it should be any money, but it's about wealth creators putting their wealth into uninvested communities. So what are opportunity zones? Basically, they are fixed census tracts. They survive as noted for the entire 25 more years or so of the program. The program goes to 2047. Many people have misinformation about when it ends, but literally you can aggregate capital appreciation in opportunity zone structures until 2047. Each state was entitled to name 25% of their low income census tracts as opportunity zones. Puerto Rico is an exception. All but 4 or 5 or 6 of their census tracts are opportunity zones. It was, this came out about the time they were kind of digging out from under their hurricanes. So almost all of Puerto Rico is an opportunity zone, but otherwise it's 25% of the census tracts of each state. The tracts were almost uniformly well chosen to benefit people who and communities that need benefit. There are a few that people criticize, but a few out of almost 9,000 is really hardly anything to speak of. And you can see that these communities, this data suggests that number one, there's plenty of opportunity zones to look at. They're not all, disaster areas, but all of them can benefit, and there's plenty of ways to figure out how to put your business or your real estate investment or your other tangible asset investment in an opportunity zone. So it shares some similarities with Section 1031 like-kind exchange, which has been clarified relates only to real estate, but it's extremely, it's much more flexible, and it's got, and frankly, I've never totally understood Section 1031. You have to invest all your proceeds from a prior investment into another, but you're doing it in the same economic environment. So what's the point? I mean, real estate floats up and down, fairly correlated with general macroeconomics. Why would you bother to sell and reinvest? I'll give you an example. We had a client come in who had sold his 350 unit apartment complex at a cap rate he never thought he'd see. So he looked at 1031, the deal, and he realized that he could only find apartment complexes with the same kind of cap rate. Well, why would he do that? So what you can do in opportunity zones, number one, you don't have to invest all your proceeds. You only have to invest your capital gains. Now you can invest all your proceeds, but the invested dollars that get this benefit are only your capital gains. And so he could invest that in a development of another multifamily asset, which he would build to the cap rate he liked. So it makes a heck of a lot more sense. The other thing about 1031 is that the ultimate end of doing 1031 exchanges is to achieve a step up for your heirs upon your death in the basis. So that's when it all becomes really, really valuable. What we're going to see is that we actually don't have to die to get a step up in basis under the opportunity zone statute, which is, I mean, maybe selfish of us, but it's nice. But in general, like 1031, you have 180 days from the transaction that creates the capital gains to get invested. Now, there are amazing extensions that now exist today because of the COVID pandemic that's, frankly, you can use capital gains that you've generated from as early as January 1, 2019 in opportunity zone structures, so long as you get invested by March 31 of this year. That leaves us about a month and a half. So basically you get something like 800 and something days now for maximum, depends on how you generate the gains, to get invested. That means people can go back and check their prior tax returns and see what capital gains are on there, get them invested appropriately into a QOF, Qualified Opportunity Fund, and get a huge tax refund on their capital gains from their prior years. The basic dynamic is that if you achieve capital gains from any source at all, not just real estate. Look, I have been a cryptocurrency guy to some extent, mostly transactional and legal and compliance, for about 5 years. When I saw PayPal was going into cryptocurrency a month or two ago, and I'm not a big cryptocurrency investor, but I bought a bunch of cryptocurrency. I've more than doubled my money in the last month. All of that short-term capital gains, I'm going to be putting into a QOF. Short-term capital gains are an absolute no-brainer to put into QOFs. And the reason is they're probably fully taxed. In other words, Biden is unlikely to increase the tax rate, and the tax rate is at ordinary income rates. So you get a huge benefit by investing short-term capital gains. Long-term capital gains, there's a little more of a discussion about whether you should pay the tax. I think you should still do it because you can build incredible wealth, almost like a Roth IRA, by investing in opportunity zone structures over the long haul. So it's gains from selling your business. They're called 1231 gains. It's gains from selling art, horses, stocks, bonds. One little unique thing is that when you're a writer of music, a songwriter, you can sell your portfolio for capital gains. Interestingly, other developed art, you can't. Bob Dylan just sold for several $100 million his portfolio. So you can put that all into an opportunity zone structure. One interesting thing where some real estate people get tripped up is that if you're a developer, let's say of condos or developed lots, that's ordinary income. That is not capital gains, even though you're selling a capital asset, because you're selling out of inventory. Now, we can do other things to moderate your tax position if you're a developer, but those gains from development are not capital gains in general. All right.
Hey, Gerry, can I jump in with a quick question that was relevant here to what you were just talking about, especially with 1031 stuff? Clint Nolan, one of our good friends, question is, it's been our understanding that 1031 money cannot be invested into a real estate development pre-construction. Based on what you've said, it sounds like that's not the case. Can you clarify, please?
Well, I'm not really giving a presentation on Section 1031. But
Right.
having syndicated a lot of 1031 deals back at Behringer Harvard back in the day, we originally were doing them as tenant in common deals, and then we did them as DSTs, Delaware Statutory Trust. I will tell you, yes, it is very difficult to do a development through a 1031 because it's not really a like-kind exchange. There are ways to finagle some development. Kind of, you can overinvest, but that's a very technical question. But in general, it's very difficult to do a development that qualifies for 1031 basis transfer.
Yeah, and Clint, we can get you more answers with our 1031 company as well on that, and get you connected with those people to have more in-depth combos.
I've seen again, it's been a few years since I've done 1031 deals, syndicated 1031 deals, but I have seen 1031 accommodators suggest that this is doable. I've not been really comfortable with their advice, and I almost kind of think that, well, they would like to just have their money in escrow. The beautiful thing about the Opportunity Zone statute is you do not have to track or escrow your proceeds like you do in 1031. If you generate $100,000 in capital gains, a capital gains sale, and you go and lose it all in Las Vegas, you can borrow $100,000, and as long as you get invested in the right time frames, again, generally 180 days, that works to offset your capital gains that you had generated. By the way, the other thing we do as far as planning is if you have some capital gains today, we'll set up structures that create the Opportunity Zone structure, and there's other liquidity. We loan that money in to go get started on whatever you're doing, setting up your business or doing a real estate investment or otherwise investing through Opportunity Zone. And then when the later capital gains comes to fruition, we pay off that loan. So we can kind of it's almost like short selling in a way, but we can create devices. And this is why you leave the stuff to the experts. But just know what you want to do and then bring it to either a CPA, a tax attorney, or someone like me, a corporate securities attorney who's very familiar with this, and let's figure out how it works. But yeah, good question. Kind of vaguely remember the answer to that, but yeah, it's not easy to do a development 1031. Now, as I mentioned, when you generate those capital gains, in general, you have 180 days, subject to now the 800 something days because of the COVID, to get invested. However, if you happen to hold your capital asset through a pass-through entity, i.e. a partnership, an LLC tax to the partnership, et cetera, well then, and by the way, we can go back and construe a multi-owned entity as a general partnership. In other words, there's a leg to stand on that, if I'm investing with another person, I meant that to be a general partnership. In any event, and then we go back and do, appropriate tax filings, backfilling. But if you held your capital asset through a partnership structure, you not only have the 180 days from the date the partnership realized the capital gains, but you also have this other period, which is from December 31 of the year in question, when that was realized, through about September 14th of the following year. That's a huge advantage. I see I misspelled September there, didn't I? It's a huge advantage because you have more time to figure out what you're going to do. And the reason you have the IRS granted this is that people who hold interest in partnerships don't necessarily know what their capital gains are until the K-1s are returned, right? So, but what I recommend to folks considering capital gains or opportunity zone investing is that they consider contributing the capital asset they're going to sell pretty soon into a LLC that's taxed as a partnership, or a partnership taxed as a partnership, before they sell, so they have this greater flexibility. So that's what the bullet point presents planning opportunities for anticipated capital gains events is pointing toward. The tax benefits, again, the main tax benefit is that after a 10-year hold, any disposition of either your investment in the structure, and it has to be a two-tiered structure with what's called a QOF, Qualified Opportunity Zone Fund, and a QOZB, Qualified Opportunity Zone Business, which in real estate, that business then will do the development or the real estate investment. A two-tiered structure is that you get to step up your basis in your entity. The investor gets the benefit. He gets to step up his basis to fair value on disposition. Or if the underlying assets have been held 10 years or longer and they're sold, that you get to step up the basis in the underlying assets up through the investor to fair value. That's huge, right? There are other two minor benefits. I almost hate talking about them because you do the deal this way regardless of these minor benefits, and people get all wrapped around the axle on them. They get confused as to timing, but there are two minor benefits. As to the capital gains that you're making your investment into your QOF structure, you get your tax deferred until tax year 2026. So if you look at this timeline, and it's because it started really in 2018, that's where I've got it. If in 2018 you had created a capital gain event, then you wouldn't be taxed until 2026. Okay. But you're going to be taxed at the rates at that time. So capital gains rates could be higher, could be lower. Short-term, long-term rates are different. But even doing the analysis of what Biden's is, and Biden may not be the president at that time, right? There'll be a new president in 2025, pursuant to the election in 2024 or whatever. The new president might be the same one as the old one, but who knows? But even if Biden's proposed rates, higher rates exist, they have really a negligible effect because it's only taxing the gains you put in there. And it has a very, very positive effect on your long-term value accretion tax avoidance upside. So you don't pay tax on your capital gains until 2026. And if you'd been invested for 5 years or longer, you get a deemed basis of 10% of that capital gains you invested. So if you had $100,000 and you invested by the end of this year, you will have been able to held that investment for 5 years to 2026. You'll get a deemed basis of $10,000. So in 2026, you'll be taxed only on $90,000 of your capital gains. Does that make sense, Lee? Does that follow?
Yep, I'm following along.
Now, if you had invested by 2019 and you had a 7-year hold, you would also get another 5% deemed basis of, so you would have been taxed on $85,000 of that $100,000 in 2026. As the statute currently is written, you cannot get that extra 5%, and you can't get the 10% if you don't invest by the end of this year. But there are bills out there to extend the 2026 date by 2 or more years, based upon the fact that the IRS took almost 3 years to do the rules, and based upon the fact that people want more value out of this tax incentive. So I still mention the 5% upside because we could find that we still can get that extra 5%. So in 2028, if you invested in 2018, again, in 2027, you will have to come up with the cash to pay that tax. In general, most people are planning around that by looking at doing a refinance at that time, or holding back some of the income that is produced over the period of time, or simply just counting on having liquidity. Well, you can, by the way, you can borrow on your top line investment too, on your top QOF, and we'll see what that structure looks like in a second. And then if you held your 2018 investment and disposed after the 10-year anniversary in 2028, you would simply write up your basis from where it was to then fair value, fair value is likely going to be whatever that transaction was that you realized, because that would be considered an arm's length fair value deal. Interestingly, in real estate, now this does not apply so much in other assets or in businesses, this also results in tax-free income. So all along the way, when you invest in real estate, you have untaxed cash flow because of the effect of non-cash depreciation deductions. When held in the partnership form, those non-tax depreciation deductions reduce the basis of your partnership interest. And all of these basically are done as partnerships. When you sell, you have a portion of that reduction in basis that is taxed under recapture rules, which is higher rates than capital gains rates, long-term capital gains rates. So since you write your basis from where it might have gone down to because of the effect of those untaxed cash flow distributions, right up to fair value, you not only skip your capital gains, but you end up never paying tax on that untaxed cash flow that was distributed. That's one thing that's unique to real estate investing. On the investing in businesses side, you expect, real estate is a lower risk investment than investing in businesses, but it's also potentially a higher return. If Lee and I were to set up Google in, let's say, the Plano Opportunity Zone up by between Parker and Legacy and 75 and Jupiter, if we were to go get an office and set up Google today, in 10 years, Google was worth billions, right? If we had invested in a way that it was an Opportunity Zone business, we could sell that business with entirely tax-free, unlimited upside, tax-free. So, but Google, was one of only a few that succeeded in that environment, right? I mean, Google replaced all kinds, Alta Vista, all kinds of other search engines, right? So higher risk, higher reward, more tax benefit for investing in businesses, but real estate's pretty reliable, as we all know in real estate. So how do we comply with the statute and set up an opportunity zone and invest? Well, the statute doesn't allow you to invest directly in whatever you're investing in an opportunity zone. In fact, if you do that, you've ruined the opportunity to set this up as an opportunity zone investment, because you cannot invest, you cannot gain the benefit of the opportunity zone incentives by taking something you already own and placing it into the structure. You can't do related party deals. So you have to, in general, acquire your opportunity zone investment, your actual physical real estate or the setup of your business, into the structure from a third party, not from somebody who's you're related to. And that structure is to set up something called a qualified opportunity fund, often referred to as a QOF. And you don't have to ask anybody's permission to do this. All you have to do is set it up correctly. And by the way, you'll set it up wrong if you don't use an expert. It's not that much you have to do, but you have to know the magic words and how to create the entity and that kind of stuff. All you have to do is file with the IRS and say, hey, we're setting up a QOF and we're going to be responsible for future compliance. It's all you have to do. And then you put your capital gains into that QOF, evidence of that by setting up a bank account and showing it being funded. On your personal tax returns, you'll file a special form, I think it's 8997, that shows I have this capital gains in 2020. I put this much in an opportunity zone. I have no current tax. And then you have annual compliance. Again, you voluntarily file forms that show you're complying. Just skip ahead real quick. If you look at the circle, that is well, let me see. That is the QOF. The QOF invests in the qualified opportunity zone business, and the qualified opportunity zone business owns property or the active business. So that's the structure. Now, what are assets that work? Well, the point of the statute was to get wealth creators to rapidly, within 180 days, subject to all these COVID extensions, to rapidly take their wealth and put it into underinvested communities, and then keep their and buy and create new assets or new businesses or build businesses and keep them there for 10 years or longer. So what are the assets that work? Well, they must be assets that haven't previously existed in that opportunity zone. You can actually take assets from outside the zone. So for instance, I'm helping somebody do a Bitcoin ATM arrangement. He can buy an existing asset outside the zone under the structure and then move it into his QOF in a 7-Eleven or whatever in an opportunity zone. That works. It doesn't have to be a newly manufactured asset. It has to be new to the zone. And when it comes to real estate, you basically have 5 types of assets. New construction from the ground up, new construction from abandoned, where that has abandoned improvements on it that have been abandoned for at least 3 years. Redevelopment assets, but that's problematic because you have to redevelop at least to the value of the then current improvements. Most of the redevelopment opportunity zone deals are historical tax credit deals because they so minimize, how much you actually have to invest. The 4th item is any assets acquired from a municipality through condemnation, foreclosure, whatever the case may be. So you can have an ongoing business or whatever on their ongoing improvements. And the last one, which is really interesting, especially for developers, is basically spec built assets. So we're doing a ton of work in Broken Bow, and people are building spec cabins and selling them. When a family or an individual buys a spec cabin, even though that didn't qualify for the developer as an opportunity zone asset, it qualifies for the purchaser because it's never been used before, a first use asset. It's also great for people building condos, developers building condos in opportunity zones, because every one of those condos, if they're being sold for rental purposes, can be an opportunity zone asset. You can get all these benefits. Now, keep in mind, the underlying investment has to be a trade or business. A rental home for yourself or a condo for yourself, or one that's structured as a second home where you rent it out from time to time, will not qualify as a opportunity zone asset.
Hey, Gerry, we got a quick question. I think this slide is going to be really important since a lot of people's core business here is in real estate. Barry Stokes asks, how are abandoned assets defined as simply being vacant for 5 years or that the previous use/zoning has been prohibited?
No, it's abandoned for 3 years and it has nothing to do with zoning. Just has to be abandoned.
Okay, gotcha. Can you go back real quick? Because one of the things that as I speak to people, especially about this even, value add multifamily, for example, there's a huge need across the country for, especially in opportunity zones, for workforce, sustainable housing at that income level. Can we run through a scenario where there's no way of making if you buy a $5 million multifamily asset, to make that qualify for an opportunity zone, to make sure that you can completely renovate that, make it a better property? Is there a process for which that can happen, or are you saying that because it's already been used as a multifamily asset cannot work in the opportunity zone?
Well, here's an example. If you buy, let's say, a Class C 100-unit apartment complex, and the land is worth $5 million and the improvements are worth $5 million, the way to make it work is you're going to have to invest $5 million, not the value of the land, the value of the improvements, $5 million into the renovation, the redevelopment that you do. Now, that's almost never economical to do that, because remember, this is a tax incentive, and if you don't produce a positive investment, the tax incentive is irrelevant, right? I mean, losing money is not going to give you any tax benefits. So that's why I say that in general, teardowns or historical tax credit deals are the ones that work for the substantial improvements.
Mm-hmm.
Does that answer your question?
Yeah. I think the example's extremely helpful.
Now let me give you an example though of the first use. I am aware of opportunity zone funds, including a public fund that is scouring the country for people who've built apartment complexes, offices, or whatever in opportunity zones, whether they set them up as an opportunity zone deal or not. Because as long as they come in and acquire that asset before it's been rented out to anybody, it can work for that other fund. Even the developer, I've got a deal in Nashville where we're working with the developer, and a very prominent real estate private equity firm is their LP at Austin. It's in an opportunity zone, but for some reason that private equity firm did not want to set it up as an opportunity zone deal. Well, that can nonetheless be purchased before you lease it out as an opportunity zone asset. Now, I tried to encourage them, even though they might not have had capital gains or been set up to do an opportunity zone deal, to nonetheless set it up as an opportunity zone structured deal. And I'll tell you why. Number one, you actually don't have to have capital gains to set up a qualifying structure. It's just that you won't get any benefits as the investor in that. The benefit you will get, however, is that there is going to be a huge market for roll-ups of opportunity zone structured deals, because QOFs can merge into each other tax-free. So what you're going to see is public and non-public companies going around and acquiring QOF structures, which can, by the way, well into once you're a QF structure, you're always a QF structure. So you can build. So this group could have built this in a QF structure, even though they had no capital gains, completed it, stabilized it, been creating current income, and then another QF could come in and merge with it, all qualifying, even though it's a fine operating asset, right? And what that group forewent, because of their unwillingness to set up as a QF structure, even though they had no capital gains, was being able to participate in what will be a very dynamic roll-up market with parties who are willing to pay more than anybody else because they are doing it on a tax-adjusted basis. All right, they're, these private equity guys, they're the masters of the universe, so they must know more than me. So anyway, you can see that when you start focusing on the opportunity zone space, the opportunities, to be redundant, become manifold. It's almost like you got 1,000-piece puzzle for Christmas, but it can be built, it can be assembled into 1 million different things. It's just an amazing area. So let's move on. So I've talked about the kinds of assets that qualify, as far as investing in businesses go, operating businesses, that QOZB level, it just has to have 70% of its assets qualified. This is helpful both from the point of an opportunity zone business and operating business. So for instance, we have a client whose real estate development specialty is in coming into, what do they call it, brownfield and other near into CBD areas that can be gentrified and, you know, are convenient to the downtown area or wherever the case may be, but, you know, need good assets, condos, apartment complexes, etc. They have accidentally become a very vibrant opportunity zone developer, because that tends to be some of the areas that they're doing their developments in. But there is a way for a developer to, even though this has to be a 10-year hold, to continue to operate in the manner which they're used to, that is, develop and get out. That's called crystallization and stabilization. So many LPs will allow you as a developer to go ahead and develop, and then when you stabilize, you value the apartment complex or whatever it is without having to sell it, and then the developer can stay in with a new capital structure, or can be taken out with a refinance. But some LPs don't let you get out, and so that's a choice you have to make. Maybe you go get another LP, but this particular developer has a few where they kind of want to stay in for the 10 years, kind of blending their return dynamic, right? And as a result, they've created a property management company to manage these opportunity zone developments that they have created over the next 10 plus years. Well, we set up their property management company as an opportunity zone company. Hey, it's only dealing in opportunity zone assets, right? And now, as they grow that property manager for the next 10 plus years and create recurring revenue, that's going to have a value that they can sell tax-free. Every asset manager of a fund should be set up as an opportunity zone. Any business that is agnostic geographically, all we have to do is make sure their underlying assets that are leased or owned, include leased assets. You value a lease by its stream of payments. That 70% of those assets qualify as opportunity zone assets. But furthermore, let's say you create, I'm going to talk about a captive opportunity zone fund in a second. If you are investing in, I don't know, duplexes, cabins in Broken Bow, condos that you rent out, 30% of those assets can be anywhere. They don't have to be in opportunity zones. And meanwhile, you're growing that portfolio for a tax-free exit 10 plus years. So it's important to know that you have a lot. Let's say you're a restaurant company and you have restaurants all over the country. You should have one subsidiary that's an opportunity zone subsidiary and one subsidiary that's normal. And every time you happen to have a restaurant in an opportunity zone, you should put it over in the opportunity zone subsidiary, right? And by the way, for every 2 of those restaurants in an opportunity zone, you put 1 more over here that isn't in an opportunity zone, right? And this subsidiary, when you eventually exit, will be sold with the other subsidiary, and this side is going to be tax-free. So any kind of multi-geographic dynamic, which blends between real estate and non-real estate.
Well, Gerry, real quick too, going back to your management company anecdote there. I mean, a lot of the problems too are that could solve another major issue. If you have a higher value on your management company, that would help you sign on debt much more easily. That's another main issue that, you know, multifamily people run into, right? You're signing on a lot of debt, but if you have a higher value because of that tax-free basis, that also helps solve another problem that people run into quite often.
Right. Oh, and by the way, as far, you know, it does cost some money to build service companies. You have to hire great people. That's a fixed cost, blah, blah, blah. If your structure is an opportunity zone company, just think how much more, you know, I did a spell check in this thing and it did not, I noticed that it didn't catch everything. It seems, just think how much more likely you're going to get outside investment if your outside investors know that there's a tax-free upside. So we've got a developer now that's looking to grow its business, and we can set up some of its businesses for investment that will be tax-free upside for the investors. So anyway, that was what I'm talking about. Now, the interesting thing is there's 2 tests for an opportunity zone business. One, it has to have 70% of its assets as qualifying assets. 2, it has to have 50% or more of its revenues attributable to opportunity zones. But the IRS made it really clear. We want businesses located in these underinvested communities that generate worldwide income, right? So if that's the case, how does it work? Well, number one, there's like basically a waterfall of qualification. Number one, well, where is the revenue actually created? Well, if you're doing a real estate development, a multifamily apartment complex, whatever, obviously all of the revenue is generated where that is. So that's a no-brainer. So where's the locus of your revenue? Number one. For the property management company I set up, well, initially all the assets are located in opportunity zones that they're property managing. So that's a no-brainer. Now they can start adding assets to manage outside of opportunity zones, and they just have to watch and make sure that for this top line qualification, that the revenue is 50% or more from assets in opportunity zone. Well, let's say they grow and grow, and their revenue is now from properties that are not in opportunity zone. Well, there are other qualifying tests. One is if you have 50% of the hours of your personnel performed for your business in an opportunity zone, basically in your opportunity zone office, you're going to be deemed to have 50% or more of your revenue, even though it may be worldwide, from opportunity zones. Next, if the cost of your personnel is at least 50% from performance of the personnel services in an opportunity zone, that will also deem you to have 50% of your revenue from opportunity zone. And I will point out, we had offices in Preston Center on Sherry. People in Dallas know what I'm talking about. And until last May, basically from March to May, nobody was coming to the office. So we just abandoned. I mean, fortunately, we didn't have to break a contract to do it. We abandoned our office. We're now all working from home. And what I'm trying to do is find an office in an opportunity zone. Deep Ellum in Dallas is an opportunity zone. That Plano area actually is a little more convenient for me. So I'm considered a contractor, a personnel for my clients. I will benefit my clients when I get that office by performing my services for them in an opportunity zone from these two tests. Some people think that accountants and lawyers don't count, but it doesn't say that in the statute. So it's kind of a gray area there. But anyway, the net is I can benefit them when I get moved up there. And I just, frankly, have been a little bit too lazy to get up there because I'm getting really comfortable working from home. But in any event, we're going to do it eventually because we've got other businesses we're creating. We're creating some investment funds, actually, and they're investment funds that are investing in tangible assets that are not real estate. It's really kind of fascinating. Anyway, the fourth safe harbor is kind of a subjective one, and you're going to need to get a legal opinion to be sure that you can support it with the IRS, or an opinion of a CPA or whatnot. But it goes kind of like this: the tangible property that you use for your business and the management and operational functions of your business that are necessary to produce 50% or more of your revenue are located in an opportunity zone. It's kind of a corporate headquarters test, but it's a little more than that. And there isn't a lot of learning on it yet. But essentially, if your CEO and CFO and your executive team is in an opportunity zone, and perhaps your accounting group is in an opportunity zone, and your basic operational stuff, then you can have people all over the world. But they couldn't produce revenue without your core principal office. Then you also qualify as producing 50% or more of your assets. And then there's a kind of a global facts and circumstances that the IRS threw in there for things they didn't think about. So anyway, so you can see there's really interesting ways to set up businesses. Now, this is almost entirely irrelevant to real estate development, right? Because it's a stationary asset and it's either in an opportunity zone or not. And if it's in an opportunity zone, that's what it's producing.
All right, Jerry, 1 second on that point. Got another question here regarding the setting up property management companies. This also comes from Clint Nolan. He asks, it sounds like if I were to set up a property management company in an opportunity zone office, which manages multifamily properties not in opportunity zones, so long as 50% of the work happens in our West End office, that company's income would be tax-free. Would the same not apply for development income derived from developing non-OZ properties, so long as more than 50% of the development work happens from the opportunity zone office?
That is a fabulous question, and it points up to a weakness in my presentation. And the weakness is this: I failed to make clear that the production of income gets no benefit from the opportunity zone statute. Ordinary income production is taxed per normal. It's only the sale of your business or the sale of your real estate investment or the sale of your overall opportunity zone structure that gets the step up in basis. As you walk down your history of doing business and running an apartment complex, or the case may be, all of that ordinary income is going to be taxed per normal. Now, that's subject to the fact or the result that I mentioned about the tax, the untaxed cash flow, which ends up being tax-free. But untaxed cash flow is generally not all the cash flow that is distributed. Some of the cash flow for most real estate developments that is distributed is going to be taxable. It's only the cash flow that's protected from current tax because of the effect of non-cash depreciation deductions that end up getting that benefit. You with me?
Yep, that makes sense. Clint, again.
So number one, when you think about whether you should set up a business as an opportunity zone company, the ultimate question is as follows: can this business be sold in a profitable way from 10 years or later from now? And basically, if it's a business that produces recurring revenue creates a way to value a business. That's a good idea to set up as an opportunity zone business. If it's a developer, it's probably not a good idea to do that, because developers create episodic income, not recurring income. I mean, it may be. I mean, if you can kind of show a historical tax record that you're always developing, even though it's episodic, and you have value, I mean, that's not that it's not saleable. It's just not as reliably saleable because it so much relies upon the developer constantly finding the next deal to develop and getting their development fees, right? Now, if that developer is generating promotes and carried interest and things like that that create value, you know, that's value creation too. But net, the analysis is this a business I can sell for a profit 10 years or more from now? And a property management company is, because it aggregates more and more properties that it's managing. It produces monthly recurring revenue. So that's a pretty nice business. An asset management business is as well. They're building up more and more funds that they're managing or assets they're managing, and that is recurring revenue, right? So
Yeah, that's helpful and yeah, much more clarifying. Thanks, Jerry.
Yeah. So again, because of the ethos of this statute that you're supposed to get your money invested in tangible assets and businesses, you can actually run afoul of restrictions on having cash. Technically, at the QOF level, you cannot have more than 10% of your assets by value be in cash. That's why you almost always create a QOZB and push your cash down to the QOZB, the Qualified Opportunity Business that is owned by the QOF. But still, the QOZB's assets are attributable to the QOF, so its cash will be attributable up the way. So the IRS understood that, look, you're going to have some cash to build businesses, to develop real estate assets. So they created a concept where cash for which you have a 31-month budget to expend, whether it's for a development, whether it's for creating the next Google, as long as you create a budget and you relatively substantially comply with it, that cash will not be considered bad cash. Interestingly, that safe harbor got pushed out to 55 months. The real point of this is as follows. Recall that you have to get your capital gains invested within a certain period of time, generally 180 days. What it really means is that you only have to worry about getting your cash into an entity that decides to be taxed as a QOF. It can push it down to a QOZB, and the QOZB can adopt a budget and take some time, 31 to 55 months, to figure out what to do with it. So for instance, at the end of every year for the last few years, we've had tons of folks who've sold their businesses or whatnot. And what we'll do is set up all kinds of QOFs with different amounts of money in them, or one QOF, fund it. So they get, this really happened in 2019, which was the last year, get your 15% step up for 2026 tax. And it'll happen again this year because this is the last year to your 10% step up. Just get in that QOF, we'll figure out what to do with it later. But now we've got our holding period running, and we can find an investment, we can find a developer to invest with, we can create a business, we can find an opportunity zone fund to invest in, whatever the case may be. A friend of mine, a guy named Julio Gonzalez, has a great firm, just recently posted this on LinkedIn. His firm does cost seg analysis, the engineering firms that do that, among other things. But he had this little pictograph, whatever it's called, and I don't even know if it's true because he is known for exaggeration. But he pointed out that 1 penny doubled daily for 30 days turns into 5.3 million. I kind of find that hard to believe, whatever. But he said, look, if that penny, you have to subtract 35% in taxes in 30 days, it's only worth $20,000 if you double it. That is the value of the opportunity zone environment, right? It's capital accretion untaxed. It's like a Roth IRA. In fact, I'm doing an article with one of my colleagues, actually with 3 of my colleagues, where we're comparing Roth IRA investing versus opportunity zone investing. Generally, that's important for families, family offices, individuals, high net worth persons to think about, because they can create a version of their own, kind of captive Roth IRA with none of the restrictions of a Roth IRA. You can only make a certain amount of income before you are unqualified to do a Roth IRA. A Roth IRA, just for everybody to understand, you put in after-tax money into an IRA, it grows tax-free, and you take it out tax-free. Unlike a regular IRA, which put in pre-tax money, it grows tax-free, and then you pay taxes when it comes out. Lee, you have a question?
No, I was just gonna say, I want to be respectful also of people's time come up here on an hour. Wanted to see if anybody had specific questions. If you want to raise your hand, happy to open up the mic for specific. I know it's a lot of times easier to go back and forth with Gerry on specific stuff that you either have looked at or had questions on as he's gone through his presentation. So please let me know if you do. I'm happy to open up your mic.
So this is a slide on creating captive opportunity zone structures. Many people on this call know that Broken Bow is exploding. It's in McCurtain County, which is the poorest county in Oklahoma, which is located on the southeast corner of Oklahoma, where Texas and Arkansas and Oklahoma meet. It's among beautiful mountainous, hilly areas covered in trees, lakes, streams, Broken Bow Lake, and it's just gorgeous. And it's become a huge magnet for Dallasites to either get second homes or do rental homes as cabins in the woods and things like that. And so we're creating these captive. We do everything from these micro opportunity zone arrangements to big funds, $100 billion funds. We're helping out, right? And developers in between. So but what we're creating is these kind of Roth IRA structures where these families and family offices, et cetera, put their capital gains into it. They can also put loans into it. They can put other equity into it, but that's not advisable because that dilutes your equity upside tax-free, but loans into and whatnot. And for the next 25 years, they're going to build the value of their portfolio tax-free, subject to taxable income, and they're going to keep their income in it, and they're going to refinance. And now we only have till 2027 to put capital gains into these structures, but post 2027, they're going to loan it money, they're going to refinance, they're going to build that value of their corpus so that in 25 years, in 2047, they'll sell it to themselves and get a valuation and step up their basis. And now they hold this incredible portfolio of assets that they've built on a tax-free value accretion basis for 25 plus years. So we're creating these all the time for folks.
Well, the big difference too, Gerry, with, I mean, you mentioned the Roth, which I think a lot more people are familiar with, but there's obviously a yearly limit for your Roth. So, and there's no limit for opportunity zone stuff. So
no limit. And you can pretty much, again, you can stick money into it regardless that it's capital gains through loans. Now, there are some worries about over leverage in that regard, but it kind of resolves itself over time as you later get more capital gains to pay down those loans, or but we're just encouraging people to keep building the portfolio value. So anyway, I'll get these typos fixed. I don't know why it didn't do the spell check when I did it. Oh, by the way, we're doing a 10-year out amusement park development in an opportunity zone. And obviously that's phased. So we're creating a structure so that we can fund each phase separately with opportunity zone money. And so it's a mixed use thing. So when you have a mixed use long-term development, you need to be very strategic as to how you phase it out and pull them because of these timing dynamics in the opportunity zone statute. So you don't have to do just single asset developments. You can do large multi mixed use arrangements that take a long time to do. So what's it all come down to? Look, we think that the statute is going to remain in place regardless of a change of administration. We think that if they increase tax rates, it's only going to be more attractive to use these incentives. There may be some reporting, because right now there's no reporting required. The government doesn't even know how much is being invested in this stuff. I mean, they can kind of guess by the QOF certification filings, or they self-certify. We think this is going to be a long-term thing. Of course, in the United States, they can always change the taxes, but we're continually confused as to why people don't know about this and why they're not thinking about it all the time. So look, if there's any, so this basically says you can't hold me responsible for anything. So
the good lawyer
yeah.
had to put that up there.
Yeah. So if there's any questions and people want to chat, I actually blocked off a bit of time after this. Happy to engage in just collegial chat. Let's open it up.
Yeah. Well, appreciate again, Gerry. I think you're right. There's once you learn about it and dig into it, there's a lot of reasons it makes a ton of sense. I spent some time on the IRS website this week as I was preparing for this, and I think part of the reason is the government's inability to clearly articulate a clear message and the potential for changes, as well as you discussed, even though this seems like a very positive bipartisan thing. But yeah, spending time on the IRS website will give you some brain damage very quickly.
Okay, Lee, I don't know. I don't know if I can see the chat. Let's see.
I'm following. I don't see any yet. Yeah, if we don't have any, I will share certainly these slides. I will share we'll share the recording also with people who weren't able to make it here. And of course, we'll share your information, Gerry, so if people need to reach out or have specific questions that they come up with afterwards or as they're thinking back on this conversation, they can certainly reach out to you directly. So really appreciate your time again, and your expertise has been incredibly helpful for everybody here. So
great.
Yeah.
All right, it's been a pleasure.
Yeah.
Let me figure out why my spell check doesn't work, and I'll get you a corrected PowerPoint that you can share with, frankly, whomever. In fact, I think I'll probably post this. We have a number of Opportunity Zone LinkedIn groups. If you look for Coasis Coalition under LinkedIn groups, you're welcome to join any of them. We have one specific to Broken Bow. We have one for tax professionals, investment banking professionals. Feel free to request to join any of them, and you can keep track of developments.
Yeah, Gerry, we actually have one quick question here from Anita on our team. Actually, she was asking about if you could touch quickly on the look back option on capital gains for prior years, and just give a little bit more.
Okay, yeah. So as I mentioned, you have either 180 days or that extra period if you sold a capital asset through a partnership structure. However, as a result of the COVID pandemic and some very favorable IRS allowances, if you held a capital asset through a partnership and that partnership sold the capital asset at any time from January 1, 2019, you can create and or invest in a QOF with your allocated capital gains. If you do it by March 31, of this year, that's like 800 and something days. So everybody should go back and look at their prior tax returns and see what they can do. And frankly, we can get captive Opportunity Zone structure set up for people in a day. Now, we can't get all the paperwork done in a day, but we can get all the stuff necessary to evidence that you've done it, and we backfill the paperwork, right? And we do that. We don't really get much compensation out of that because we do it fixed fee, but we kind of believe it's a price to pay for being proceduralizers for this space to help it grow up from the bottom up, not just the top down. If you held an asset individually in your own name as a taxpayer, then any gain you had from October 5, I believe, of 2019 can be used to invest by March 31st.
Great. Awesome. Thank you for that clarification. All right. Really appreciate it again, Gerry. We'll see you again soon, and thanks again for taking the time.
Great, my pleasure. Thanks for having me. I love your title company, good entrepreneurial guys. Entrepreneurial guys are the best guys that help getting your deal done because they think like business guys. So that's right. I always prefer title companies that are less on the functionary side and more on the entrepreneurial side. So good on you.
Appreciate that. All right. Have a great day. Thanks everyone for joining.